The naturally occurring sentiment shifts that we forecast using the physics-based drivers do not explain all ups and downs of the stock market. Investor views on economic conditions, social and political developments, and other events also affect the market. These economics-based sentiment drivers can cause the market to move higher and lower beyond what could be expected from only the naturally occurring shifts. Together, the economics and physics-based drivers affect total investor sentiment and have a major impact on the direction of the market. It is important to assess economics-based sentiment because it can reveal emerging economic weakness that will ultimately create a need for a more dramatic price change. However, an emerging economic need is easily overlooked because naturally occurring sentiment shifts often have a larger short-term impact on market price movement. The example discussed later will show how economics-based sentiment shifts highlighted economic weakness during 2008, well before the major declines associated with the global financial crisis. These shifts highlighted economic concerns even when the stock market was moving higher. We do not measure economics-based sentiment directly because there are too many variables to consider. As mentioned, we forecast the naturally occurring shifts in sentiment using our physics-based drivers. We can, however, create a useful estimate of economic-based sentiment by measuring the price action of the market as a whole and then subtracting the naturally occurring price action. For this analysis, we use price momentum to describe price action. Price momentum measures the rate of change of price increases and more effectively captures the increasing or decreasing investor optimism compared to evaluating only the price level of the index. We use the 14-week Relative Strength Index, or RSI, to measure price momentum. It is a widely used measure in the investment industry. First, we determine the actual RSI for the market. We then subtract our predicted RSI, which is determined using the physics-based sentiment drivers. The difference between the actual and predicted RSI represents the price momentum we attribute to economics-based sentiment drivers. We call this excess price momentum, or excess RSI. The 14-week RSI is a particularly good variable to use. In addition to it being widely used, our forecast of RSI includes a wide range of our physics-based drivers, from those that shift every few weeks to those that shift every few years. Also, predicted RSI is a component of the short-term driver shown in Figure 1 of the Weekly Sentiment Forecast Report. This slide shows the price of the ETF DIA, which tracks the price level of the Dow Jones Industrial Average Index, shown by the dark blue line from May 2007 through November 2008. This period includes the early months of the global financial crisis and a market decline of over 50%. The dark red line is the actual RSI of the market index. It oscillates around its middle value indicated by the dashed red line. One can see that the short-term peaks of the market generally correspond to peaks in the actual RSI. The troughs of the market generally line up with the troughs of the actual RSI. While the actual RSI does not have a long-term trend either up or down, it is a good indicator of important market moves over a period of several months, which is why the RSI is widely used in the industry. The thin red line is our predicted RSI for the market. It is important to keep in mind that it is completely independent of the markets and based only on physics-based drivers. One can see that multi-week patterns in the predicted RSI also appear in the actual RSI and in the market index price. We can also see a period of close alignment during the last half of 2007. However, we also see that the actual RSI diverged meaningfully from the predicted RSI during early 2008. The stock market had lower price momentum than predicted, which suggests that investors became more pessimistic about economic conditions. This picture is clear even though the stock market moved horizontally or higher from January through the end of April. If one had considered only the direction of the index price to determine what investors think about future economic prospects, one would have concluded that investors were optimistic during this period. This was not the right conclusion based on our more detailed analysis of market dynamics and the large subsequent price declines. At the end of April, we would have seen that economics-based sentiment had been negative for several months and that the future trend of the predicted RSI was negative. This condition was a strong warning for future index price declines. Beginning in early May, both the market price and the actual RSI converged with the negative trend of the predicted RSI. Again, this convergence of the market to a predicted negative trend is what we seek to avoid. This slide includes a light green line that represents the difference between the actual RSI and the predicted RSI. The smoothed excess RSI, EMA line, moves above and below a center line when the differences are meaningful. It represents the exponential moving average of the differences and deviates from the dashed center line when the deviation is greater than 1/2 of a standard deviation of all differences since 1940. The smoothed excess RSI highlights when there is a persistent between the actual and predicted RSI for the markets. From May to August 2007, the smoothed excess RSI showed that the market performed meaningfully better than expected, which is shown by the smoothed excess RSI having an extended period of positive values. The market began to perform as expected from mid-August through the beginning of January 2008. As mentioned earlier, in early 2008, there was an extended period when the market had meaningfully weaker price momentum than predicted, which is shown by the smoothed excess RSI, indicating negative values for an extended period. This suggested that negative economics-based sentiment was a heavy economic load on stock prices. This was an important warning sign for the market. Thus, the excess RSI can highlight important market dynamics that are not revealed by analyzing market price alone. This slide shows the actual RSI and our predicted RSI over the 10 years ending December 2024. It shows the difference between the two, the excess RSI, in light blue. One can see that the actual RSI tracked many of the peaks and troughs that were predicted by the physics-based drivers. The price of the market is not shown on this chart for simplicity, but the trend in the actual RSI is a good indicator of the trend in the stock market. From early 2016 through the end of 2017, the strong actual RSI was anticipated by the predicted RSI. The same is true for the period from early 2020, just after the COVID crash, through early January 2021. The decline in actual RSI from January 2021 through mid-2022 was also anticipated by the predicted RSI. To reiterate, the predicted RSI uses no economic data and is based only on our physics-based drivers. The difference between the actual and predicted RSI, shown in light blue, varies considerably over time. This is largely because the predicted RSI is not always accurate to the week, even if it is accurate in anticipating the multi-month price trends as shown. We also show the flash driver in the lower part of the figure. The forecasts for this driver tend to be more accurate than those for the other drivers. The flash driver shows episodic shifts in sentiment that have abrupt beginnings and ends. Many of the episodes seem chaotic but are made up of a leading burst of optimism, a middle burst of pessimism, and a final burst of optimism. The flash driver is important because multi-month price trends are often interrupted and/or reversed when these occur. For example, this can be seen in late 2017, in early 2019, at the beginning of the COVID crash in 2020, in early 2021, and in later episodes. The presence of these episodes was a surprise finding in our research, but they have a statistically significant impact on short-term price momentum. The main points we'd like you to remember are, first, that we can forecast minor and major market inflection points. Second, we provide a revealing analysis of current market dynamics because we separate those dynamics that are naturally occurring from those that tell us about what investors perceive about economic conditions. Third, we can do these using objective data and disciplined processes, which ensures reliable forecasts over time. Visit our website to download the weekly report or to sign up for a trial to receive our reports directly to your inbox. Please feel free to contact us with any questions or comments. Thank you for watching.